Thank you, Ed, and welcome to all our customers who have signed up for this webinar. And I'd like to share with you my fundamental view of the market right now. So I have prepared a few slides. I'd like to start out my presentation by talking about why I think the market is going up. And for me, the main reason is, of course, the falling number of daily new cases. I think in my other webinars, I've talked about how crucial it is that we see the reduction in the number of daily new cases, because this would pave the way for the reopening of the economy. And this, in turn, would help the economy recover, because, of course, we have been very strict in our lockdowns to control the spread of the virus. So the reduction in the number of cases as of, I think 2 days ago, our daily new case was down to 1,761, which is very good, because previously, as you can see here, we used to be hitting at the peak 6,000 to 7,000 cases. So this is a significant reduction. And but that said, I'm not that bullish, because there are fundamental reasons why this rally might not be sustainable. I mean, there are fundamental reasons why I'm concerned. And the first one is the abundance of indicators pointing to a weak recovery despite the relaxation of restrictions. And secondly, unattractive valuations of stocks at this stage. Okay, so first things first, one of the surprises that we saw now, we're in the middle of the third quarter earnings season. And one of the main surprises that affected, or that we saw when the companies came out with the earnings, is that the defensive companies that came out with fantastic second quarter earnings actually reported weaker third quarter results, or at least, okay, I think, for example, if we are saying that the second quarter was supposed to be the worst, or the worst is over, I think the mindset is the reduction in third quarter sales should be less, or at least third quarter sales should be better than second quarter. But we saw some companies that actually reported more disappointing third quarter results. And these would include Pure Gold, URC, and RHI and SM. At least their groceries showed weaker performances in the third quarter. And surprisingly, even Globe, because you would think that Filipinos really need to be online, therefore consumption on data would go up. But then again, because people have less money and of course are less mobile, they just spent less on cell phone load. So this is a slide this is actually an exhibit that was shared by URC. And they showed how total FMCG, fast-moving consumer goods sales volumes have been during different points in time, or the sales volume growth from January to August. So you can see January to February, they're all, except for sari-sari stores and market stalls. You can see that the modern formats were doing well, were showing growth. Then early March, they were still okay. And then, of course, the time of the lockdowns, the ECQs. You see the supermarkets remain resilient. And then sari-sari stores, markets, drugstores. The expectation, I think, is that once the government shifted from ECQ to GCQ, we should have seen a slower drop in sales. But if you look here, the drop actually picked up in the third quarter. Okay, so this is concerning, because of course you would expect that there would be some drop in the third quarter, but not a steeper drop. So that's what concerns us actually. Okay, and then the manufacturing sector contracts again in October after initially recovering in September. So this is the Purchasing Managers Index. So this is just how you read it. The green line they do a survey of purchasing managers, and you would like it to be above 50 to imply that there is a any growth happening in the manufacturing sector. And as you can see here, from it recovered to 50.1 in September after a sharp drop, which is to be expected. It fell again in October to 48.5, meaning there's a contraction. Okay. And then some highlights that the IHS market highlighted in their report. Output and new orders contracted amidst weak demand conditions. And then there was a further reduction in workforce numbers. This is the only good news. Sentiment remains positive and improves in October. So, I mean, I read through the report and it just said that the manufacturers were more optimistic about 2021. I think that is the mindset of everyone when we look at how the market is performing today. Things are bad right now, but it should be better. That's why the market should go up, right? Especially as the government loosens restrictions. Okay. And this is another indicator. These are advanced indicators that I watched this from Bloomberg. So I think another reason why foreign fund managers are excited about emerging markets now, especially Asia, is because I think a week or two ago, China came out with GDP numbers and they actually were able to grow already. So China is enjoying a V-shaped recovery. And of course, we know here in Asia, at least, the COVID numbers are more under control. Okay, so maybe that's why there is a general shift in interest towards emerging market Asia because, you know, in the West, we're seeing a third wave of infections. But, you know, that said, yes, we are recovering, but the problem is after the initial recovery that we saw when we shifted from ECQ to MECQ and GCQ, it hasn't recovered much after that. As you can see here, for example, let's go to the government stringency index. So the lower the number, the better. Well, from 56 in early September, we're now down to 47. Okay, but we're nowhere near other countries where their restrictions probably 10 or 20%. We're still quite high. But more importantly, let's look at the driving mobility and the public transit mobility. So for these numbers, you actually want a higher number. But as you can see here, you know, it's still flattish. And then public transit mobility, well, it has gone up, but not much either. So in other words, people are still staying at home. Maybe they're afraid of, you know, catching the virus, or because public transportation is so hard to come by or they're a lot more expensive, people are just staying at home. They just don't want to go out. Okay, and here is recreational visits or workplace visits. Are people actually going out? I think this is a trickier part because if you go to the mall, there are some malls that are very busy right now that would, I suppose, tempt us to think that things are back to normal. But if you look at this one also, recreational visits are still down by close to 50%. Yeah, there's a slight improvement, but from down 48 or down 46, which is still a lot. Even the workplace visits, people are still staying away from the offices. Either, I don't know, they can work from home or maybe there's less work. So from down 39%, it's down 32, which is still a lot. So there, I mean, there are some improvements, as you can see. Like less people are searching for or looking for debts or ways to borrow money, and people want to travel more. Okay, but in general, I mean, people are still kind of cautious, and it's quite slow. And I think it's already proven that as people stay at home, it's not good for the economy. And I'm concerned that the fourth quarter could be weak, or 4Q GDP contraction could accelerate. Because first of all, we have a high base in 2019, especially since there's a seasonality in GDP. The Philippines, of course, celebrates the holiday season very early. We start celebrating in September when we hit the Burr months. So, of course, last year was definitely a high base. Some companies have given out the 13-month pay in the second quarter. So as far as employees are concerned, some employees will not be having extra money come this December. And remember, mass gatherings are still not allowed, so there won't be parties. And the government will not be giving any extra stimulus measures. So after the first set of ayudas that were given out in the second quarter, there are no second set of ayudas unless your barangay is locked down. Then you have these special ayudas according to Bayanihan too, but otherwise you don't get anything. So probably less money. So that worries me. Okay, so I mean, I've been reflecting about the situation, like why am I so worried? Actually, if the market were lower, I would view the situation right now as glass half empty. Unfortunately, the way the market has gone up is implying that, we are, the valuations are a bit too expensive for me, because if you look at the PE band, which measures the PE ratio of the market, we're actually trading close to the top end of the range. This is based on the 10-year PE, forward PE, and 16.8 times PE as of 2 days ago. So today it's around 200 points higher than 2 days ago. Okay. And this is for 2021 earnings. So because I think some of you might argue, it's a given naman 2020 earnings are depressed, so that would lead to higher PEs. But this is based on 2021 earnings, and as you can see, we are trading at the high end of the range. And usually when we trade at the high end of the range, it means that we are in a very strong economic footing, or strong economic scenario, which, I mean, if I were a fund manager and I see this, I'd be afraid to invest aggressively in the market, because I don't think this is sustainable given how earnings are performing. I mean, if conditions are weak, I would buy the market, but I want to buy it somewhere closer to, say, 13, 14 times, not close to 17 times PE, which I feel is a bit too expensive. Okay. And here's the thing. If you look at the PE of the index stocks, you will see that there are still some stocks that are trading at below average PEs. Okay. But the thing is, right now we're seeing some fund flows coming into the market led by institutional fund managers. And the priority has been towards large cap issues such as SM, SM Prime, JG Summit, and all these companies. But these companies are really expensive. But the reason why they're performing well is because, if I'm a foreign fund manager, I come back into the market, I want to be invested in a company that I can easily buy or sell, because it's big, it's very liquid, and it represents a big chunk of the market. So, so essentially, that's what happens. I mean, fundamentally, as an analyst, it's against my logic, or I wouldn't buy an expensive stock, even if it's a heavyweight. No? But then maybe I'm not discounting the possibility that if we want to buy this market, most likely these are the stocks that will perform well, because they are index heavyweights, and institutional investors are looking for index heavyweights to participate in the market. Okay. So anyway, so my opinion is, maybe if you want to buy this this market to participate in the flow-driven rally, I would prioritize buying cyclical stocks that are still trading at relatively attractive valuations. Okay, so we have our calling the shot stock picks. So one set is our defensive stock picks. I'm sure you've noticed that the defensive picks have actually not been performing well recently because after they've gone up, parang, o di syempre, tapos na. Now it's time to go to the laggards. Because of course, if the economy is going to recover, these laggards should catch up and perform better. Okay, so if you were to ask me, if that were the case, then I should shift my focus to cyclical stock picks. But then, for me, I'd focus more on those that are a little bit cheaper. And right now, as you can see, we have our list of cyclical sector stock picks. For the property sector, we have Ayala Land, Mega World. For the banking sector, we have BDO and Metrobank. And for the consumer, we have DNL. Okay, unfortunately here, among the 5 stocks, well, they're also starting to look expensive except for BDO and Metrobank. So I think if the market does correct in the next few days, then maybe you will still be able to buy some stocks like Mega World and Ayala Land. So DNL parang mahal na talaga. But anyway, that's just my view. If you want to participate, I think we should focus more on the cheaper stocks. So if we go here, I would focus more on the stocks that are here, that are still trading at a huge discount to their historical average PEs. At least, I can justify buying them. And I can take the view of a glass half half full rather than a glass half empty. So that ends my presentation, and thank you very much.